Something very unusual just happened. The Federal Reserve quietly stepped back into the market and bought nearly $100 billion worth of Treasury bills. No emergency press conference, no dramatic announcement, no headlines screaming crisis. Just a calm explanation. It's a technical operation. But what if it isn't technical at all? What if this move is actually a warning, a signal, that the system is far more fragile than anyone wants to admit? Because when you step back and look at the bigger picture, a very uncomfortable truth begins to emerge. The Federal Reserve may be trapped. And if that's true, then inflation may not just be possible. It may be inevitable. The Fed's $6.5 trillion dilemma. To understand what's happening, you have to go back to the last few years. During the crisis years, the Federal Reserve expanded its balance sheet to nearly $9 trillion. That's money created electronically to buy government debt and financial assets. In simple terms, money printing. Later, the Fed promised to reverse course. They launched something called quantitative tightening. That means shrinking the balance sheet, pulling money out of the system. And for a while, it seemed to work. The balance sheet fell from $9 trillion down to about $6.5 trillion. But then, something strange happened. The shrinking stopped. The system started showing stress, liquidity problems, funding pressures, instability beneath the surface. And now, instead of shrinking further, the Fed is back in the market, buying government debt again. They may call it a technical adjustment, but in practice, it looks a lot like money printing with a different name. Because at the end of the day, if the central bank is creating money to buy government debt, the effect is the same. More liquidity, more currency in the system, and more pressure on purchasing power. The $11 trillion debt wall. Now here's where things get even more serious. Over the next few years, the United States faces a massive refinancing problem. Roughly $9 trillion of existing debt needs to be rolled over, and it has to be refinanced at much higher interest rates. On top of that, the government is expected to add another $2 trillion in new deficit spending. That means more than $11 trillion in new borrowing needs in a relatively short period of time. And here's the problem. The traditional buyers of U.S. debt are stepping back. Countries like China and Japan have been reducing their exposure, selling treasuries, or at least not buying more. So the question becomes simple. If foreign buyers aren't stepping in, who will? There are only two possibilities, private investors or the Federal Reserve. But private investors demand higher yields, higher interest rates, and higher rates mean higher borrowing costs. For the government, for businesses, and for households, too high. And the system starts to break. So if the private market won't buy the debt at affordable rates, the pressure shifts back to the Fed. And when the Fed buys government debt with newly created money, that's not just policy, that's monetization. And monetization has a long, very well documented history, the pattern of currency decline. Throughout history, fiat currencies have followed a similar path. Not once, not twice, but over and over again. Weimar Germany, Zimbabwe, Venezuela, Argentina, countless examples. The sequence is almost always the same. First, governments spend more than they collect, debt rises. Then, interest costs climb, deficits grow, and borrowing becomes harder. At some point, the central bank steps in, not as a neutral referee, but as the buyer of last resort. Money gets printed to fund the government. And at first, it seems to work. Markets stabilize, debt gets financed, the system keeps running, but underneath, something changes. Trust begins to erode, purchasing power begins to fall, and prices start rising faster and faster. Because when money becomes easier to create, it becomes harder to preserve. The hidden reality of inflation. Official statistics often say inflation is under control. 3%, 4%, maybe 5%. But everyday experience tells a different story. Look at the grocery store. Products are smaller, prices are higher. That's shrinkflation. Look at housing. In the 1970s, the average home cost about 3 years of income. Today, in many places, it takes 30 years of debt to own a home. Look at food. A meal that cost $5 now costs $12 or $15. So while official numbers may say one thing, purchasing power tells another story. And that's what really matters. Not the number on a chart, but what your money can actually buy. Because inflation isn't just about prices. It's about trust. Trust in the currency, trust in the system, trust in the future. And when that trust weakens, people start looking for alternatives, assets that can't be printed, assets that don't rely on policy decisions, assets that hold value, no matter what the central bank does. And that's where the story moves next. Because while currencies fluctuate and policies change, certain assets are becoming more important for a very different reason. In part 2, we'll look at the industrial demand, the physical shortages, and the 3 possible paths the monetary system could take from here. Now let's go deeper, because this isn't just about central banks and balance sheets. It's about where the system goes from here. And there are only 3 realistic paths forward. 3 doors. One of them is already locked. One of them is wide open. And the third is the long-term endgame. But before we walk through those doors, we need to understand something critical. Inflation today isn't driven by just one force. It's being reinforced by structural demand, by real-world consumption, by industries that cannot function without certain materials. Industrial demand, the silent accelerator. Silver and gold are not just monetary metals, they are industrial necessities, artificial intelligence infrastructure, electric vehicles, solar panels, 5G systems, military-grade electronics, advanced defense systems. All of them rely on silver, because silver has the highest electrical conductivity of any metal on Earth. There is no substitute that performs the same way at scale. When a solar manufacturer builds panels, they don't ask, is silver cheap today? They ask, can we get supply? Because without silver, production lines stop. That creates something powerful. Price inelastic demand, meaning buyers will pay what they must, not what they prefer. At the same time, mining supply cannot ramp up overnight. It takes years, sometimes a decade, to bring a new mine online. Permits, infrastructure, environmental reviews, capital investment. So demand can surge quickly, but supply responds slowly. And when that gap widens, physical shortages begin to form. We're already seeing signs. Dealer premiums rising. Delivery delays extending. Inventory levels tightening. And here's the key distinction. Paper price and physical reality are not always the same. Futures markets can fluctuate wildly. Contracts can be bought and sold in milliseconds. But physical metal, it has to be mined, refined, transported, stored. You can create paper claims instantly. You cannot create metal instantly. And when more people demand physical ownership, the system feels it. Now let's return to those 3 doors, because what happens next depends on which one policymakers choose. Door number 1, the Volcker fantasy. This is the scenario where the Federal Reserve decides no more printing, no more accommodation, and we will crush inflation at any cost. They raise interest rates aggressively. They refuse to monetize debt. They allow markets to fall, allow bankruptcies, allow recession, even depression. It sounds disciplined, strong, responsible. But here's the problem. In the early 1980s, when Paul Volcker raised rates to nearly 20%, U.S. debt to GDP was around 30%. Today, it's well over 100%. Back then, higher rates were painful. Today, they would be catastrophic. Interest payments alone would explode. Housing would collapse. Corporate defaults would spike. Government financing costs would spiral out of control. Politically, it would be unbearable. Economically, it could trigger a systemic breakdown. That door is effectively locked. Door number 2, the inflationary inferno. This is the path of least resistance, the quiet continuation, the gradual normalization of money creation. The Fed steps in to stabilize bond markets, to smooth volatility, to ensure liquidity. They don't call it quantitative easing. They don't use dramatic language. They describe it as temporary, targeted, technical. But the balance sheet expands. Debt is absorbed. Currency supply increases. Asset prices rise in nominal terms. Stocks, real estate, commodities, precious metals. On paper, everything looks stable. But purchasing power erodes, slowly, then faster. Your portfolio may rise, but groceries cost more. Insurance costs more. Energy costs more. Education costs more. This is the inflationary inferno. Not hyperinflation overnight, but steady debasement. And historically, this is the path governments choose, because it spreads the pain instead of concentrating it. It doesn't trigger immediate collapse. It stretches the adjustment across years. And for savers, it quietly transfers wealth from those holding currency to those holding scarce assets. Door number 3, the Orwellian reset. This is the longer-term outcome. If inflation erodes trust too far, if the dollar's reserve status weakens, if global confidence fractures, a crisis provides the opportunity to reset the system. Enter central bank digital currencies, programmable money, trackable money, controlled money, stimulus that expires, spending restrictions, geographic limitations, automated compliance. In a world where trust in currency fades, governments may argue that control is stability, that surveillance is security, that programmability is efficiency. And in moments of crisis, populations often accept measures they would never tolerate in calm times. This door may not open tomorrow, but it sits at the end of a long inflationary corridor. So what does all this mean for you? It means understanding one simple principle. When currency becomes uncertain, tangible assets gain clarity. Gold is not someone else's liability. It does not depend on a promise. It does not rely on a counterparty. It simply exists. Silver has both monetary and industrial value. It bridges two worlds: currency hedge and consumption metal, land, energy, commodities, hard assets. These are not speculation. They are insulation. This is not about panic, it's about positioning. If door one is politically impossible, and door two is the easiest path, then inflation is not an accident. It is a policy outcome. Not because policymakers want chaos, but because every other option causes immediate collapse. So the question isn't whether volatility will come. It's how prepared you are for it. Will you trust the screen or the weight in your hand? Will you hold paper promises or tangible reserves? The market doesn't announce turning points in advance. By the time headlines scream crisis, exits narrow, spreads widen, options shrink. History shows that currency debasement doesn't destroy wealth evenly. It redistributes it, from the unprepared to the positioned. The choice is not fear versus optimism. It's awareness versus complacency. Because when the central bank is trapped and debt continues climbing, and money creation becomes necessity, not choice, the long-term direction becomes clear. Inflation isn't a possibility, it's a mathematical consequence. And in that environment, the smartest move isn't chasing volatility, it's securing durability. Trust the weight, understand the system, watch the balance sheet, and prepare accordingly. Because the real crisis won't be announced, it will be recognized by those who were paying attention.